So today I want to talk about a statement of a lower rate of interest leads to capital outflow, which means an even weaker currency, which leads to less inflows and more outflow. The statement I quoted is a common description of a vicious circle or negative feedback loop that can occur in currency markets when interest rates are cut too aggressively or when a country is perceived to be entering a weakening economic spiral. Let's break it down step by step and see when it is true, when it is exaggerated, and when it doesn't hold. So the basic mechanism why it can happen. Central bank cuts interest rates or market rates fall because of weak growth expectations, which means domestic fixed income yields become less attractive compared with other countries. Capital outflow begins. Foreign investors sell local bonds or stocks and repatriate money. Domestic investors also seek higher yields abroad. Carry trade unwinds or flight to quality. Supply of the domestic currency increases in the FX market. People sell the currency to buy foreign assets, the currency depreciates. Weaker currency raises imported inflation and or worsen the trade balance. Markets start pricing in either higher future inflation or even higher political or economic risk. Risk premium rises. Investors now demand even higher yield to hold assets denominated in that currency, which means bond yields actually go up and not down. Despite the central bank cutting rates, real interest rate can become less competitive than before. More outflows, even weaken currency, the loop reinforces itself. This is a classic currency crisis or even market doom loop that hits countries like Turkey 2018 to 22, Argentina repeatedly, Mexico 1994, Asia 1997, etc. When the loop is very likely, the country has a large stock of foreign currency debt or debt indexed to the exchange rate. A significant portion of the investor base is foreign and footloose hot money. The central bank has limited FX reserves and or credibility. Fiscal policies loose, which means market doubts the central bank will ever be able to hike rates again without causing a fiscal blow up. The starting level of rate is already very low, so there is little compensation for currency risk. In these cases, cutting rates or even just failing to hike them enough can indeed trigger the spiral you described. When the statement is overstated or wrong, advanced economies with reserve currencies, US, Eurozone, Japan, Switzerland, lower rates weaken currencies normal and often desired. It supports exports and eases financial conditions. Capital outflows are modest because the currency is still the safest or most liquid in the world. The Fed cut rates aggressively in 2008, 9, 19, 20, 24, 25. The dollar weakened but didn't enter a death spiral. Countries with strong fundamentals and large current account surpluses, for example, Switzerland, Singapore, Norway, they can run very low or negative real rates for decades and still attract safe haven inflows when global risk aversion rises. Temporary well telegraphed rate cuts in a healthy economy or 25 to 50 basis point cuts when inflation is falling toward target usually causes a modest orderly depreciation, not a self-reinforcing crash. Capital controls are very closed financial accounts. Some countries, China, India to lesser extent, limit outflows, so the loop is broken by administrative measures. Real world recent examples 2022 to 25 Turkey and Argentina. Textbook vicious circles. Repeated rate cuts or refusal to hike. Massive currency depreciation, inflation, even higher risk premium, more outflows. Japan 22 to 24. Bank of Japan kept rates at 0.1% to 0% for years. Yen weakened from 115 to 160 against US dollar. But no doom loop because Japan has huge domestic savings, current account surplus and almost no foreign currency debt. UK September 22 mini budget crisis, not a rate cut story but a sudden loss of confidence. Gilt yield spiked, pound crashed, forced the Bank of England to hike and do emergency QE simultaneously. A brief but intense version of the loop. Sweden and Norway 22 to 24. Very aggressive hiking cycles because their currencies were weakening precisely to avoid the loop. The bottom line, the statement is correct and highly relevant for countries that are already on the edge of investor confidence, especially emerging markets with large external financing needs. It is not a universal law. Major reserve currency countries and very credible surplus countries routinely cut rates and get a weaker currency without triggering uncontrollable outflows. So the full nuanced version is a an unsustainably low interest rate differential can trigger self-reinforcing capital outflows and currency depreciation, but only when markets have already begun to doubt the creditworthiness or policy framework of the country. In normal times or in safe haven currencies, lower rates just produce an orderly depreciation that helps the economy rather than destroys it. So it is very technical, so simple explanation like telling a story to a friend. So imagine your current country is like a hotel and foreign investors are guests who keep their money in their hotel because you pay good interest like free breakfast. One day you cut the interest rate a lot, you take away the free breakfast and charge extra for coffee. So what happens? So guests get angry. This hotel is now cheap and bad. They pack their bags and move to another hotel that still gives free breakfast. Money leaves your country, capital outflow. To leave, they change your money, your currency into dollars or euros. Suddenly everyone is selling your money. Your currency becomes weaker, like $1 now buys more of your money than before. Things get more expensive. Imported food, petrol, iPhones cost more. People panic. This country is getting worse. New guests hear the bad news and say, I am not coming. Even some local people try to move their money out. Even more money leaves. Currency becomes even weaker. Prices go even higher. More panic. It is a dangerous circle that keeps going down, down, and down. So real life is example Turkey 2018 to 23. Turkey had high interest rates. Guests like the free breakfast. President said high interest is evil and forced the central bank to cut rates again and again. So investors said this hotel is crazy. They all ran away. Turkish lira lost 80 to 90% of its value in a few years. Bread, petrol, everything became super expensive. To stop people taking money out, banks even limited how much cash you could take from your own account. When the same thing does not happen, counterexample, Japan. Japan has almost 0% or negative interest rate for 20 plus years, no free breakfast at all. But the yen only weakens slowly and calmly. Why? Everyone trusts Japan. Japanese people keep their money inside the country and many foreigners still think Japan is super safe. So no panic, no dangerous circle. So super simple summary, cutting interest rate, currency normally becomes a bit weaker. It is okay and normal, but if investors already don't trust you, cutting rates can scare everyone away. currency crashes, everything gets worse fast like a fire that keeps growing. It only becomes a scary, endless circle when people already think your country is risky. For safe, trusted countries, it is just a small step down, not a fall off the cliff. So thank you.